Welcome to the Voice of Russia in London. I'm Vivienne Nunes. Today we're looking at the G20. No, not the diplomatic wrangling over the crisis in Syria, though that certainly dominated the summit in St. Petersburg last week. Instead, we're talking about what the leaders of the 20 biggest economies achieved on the issue of tax avoidance. Here in Britain, we've heard a lot about multinational corporations with million-dollar profits not paying quite as much tax as perhaps we'd like them to. Starbucks, Amazon and Google are all dodging the bullet when it comes to coughing up, or so we're told. The G20 leaders now say this practice must be addressed, and they've signed up to an action plan aimed at taxing companies where their economic activity takes place. Today, we're going to discuss what has actually been achieved and what still needs to be done. Joining me here in the studio is Peter Oppenheimer, an economist from Oxford University, and Hamish McRae, financial commentator and associate editor of The Independent. On the phone is Tim Worstel, senior fellow at the Adam Smith Institute, which supports a free market economy, Emma Seary, head of development finance from Oxfam, and on the line from Moscow is Dmitry Babich, the Voice of Russia's political commentator. Thanks everyone for your time. To begin with, I want to look at the issue of tax avoidance itself. Over the past few months, it's been front-page news here in Britain. We're told Starbucks paid no corporate tax in Britain last year, despite making $600 million in sales, while in the US, Apple avoided paying billions in tax through a complex web of subsidiaries. But here's the crux. We're told corporations are operating within the law, albeit immorally. Peter Oppenheimer, is the media painting a fair picture of what's happening when it comes to tax avoidance?
Well, broadly speaking, I'm delighted to tell the media, yes, I think they are. There is a problem here. What's not clear to me is whether it is necessary or indeed of any value at all to have the G20 talking about this collectively when actually quite a lot could be done by countries acting individually. The difficulty is that countries are then scared that any benefit they get from increased tax revenue as a result of their individual action may be neutralized by them acquiring a business unfriendly image which discourages investment. If I may make a historical point, I think years ago, and I'm not up to date on this, the state of California in the United States had a law requiring companies to be taxed in that state according to the proportion of their global turnover which was made in that state. And there's no intrinsic reason, actually, why countries shouldn't do that individually now. But as I say, I suspect they're sort of politically frightened.
Hamish McRae, you were watching the G20. We've just heard Peter Oppenheimer say it wasn't the forum to address tax avoidance. What's your understanding of what was achieved?
Well, I think that it focused attention, and that's a start. And it focused attention, this is picking up Peter's point, back on countries themselves, because one country's tax loophole is another country's tax incentive. And you can't really blame companies for putting their stuff in Ireland because it has a 12.5% corporate tax rate and employing quite a few people there when rather than pay 30-something% in the United States. And I think, therefore, that cooperation between countries to agree what is a sensible tax regime, so you don't have these quirks that you can employ whereby you put all your intellectual property in one place, a little tiny country, Luxembourg or wherever, and don't pay any tax on it there, and then you make your profits there, and because it has a special deal for foreign companies, rather than actually try and spread the tax take evenly, roughly, where the business is done.
So you've said it's focused attention, so now the issue has been brought to the fore. But have any regulations been put in place or any recommendations been made so these 20 countries are given some impetus to put in place new tax arrangements?
You don't get that from the G20. That isn't what it's doing. The G20 is a new body, remember, only 5-6 years old, formed to give a wider collection of countries when the economic crash hit. And it did very well then, in an emergency, putting together a package of support which built confidence. You could say that the G20 did what it had to do then. But it's a huge body. It represents 90% of world GDP. It's 20 countries, or 19 plus the EU, who don't agree and often fight each other on various issues. We saw a bit of political discord. It isn't the right body to actually put forward concrete ideas. It can set things in motion, but you're not going to get agreement there. It can set things in motion, it can change the climate, but only in an emergency will it actually do anything.
Emma Seary from Oxfam, you were at the G20 in St Petersburg. You also think that the G20 should not be the only forum for addressing tax avoidance, since so many countries aren't at the negotiating table.
Well, we're particularly worried about the impact of any kind of tax dodging on developing countries. We work with the poorest people in countries around the world, and sub-Saharan Africa is losing the equivalent of about 2% of its GDP due to one kind of dodge that companies are able to do under the current tax regime. And, you've already touched on the fact that these companies will say much of what they do, or most of what they do, is perfectly legal, but that doesn't make it perfectly moral in our eyes, because it does suck this money out of the poorest countries. Now, one of the things that the G20 did do, and I agree with most of what the previous speakers have said, but elevating this to the political level and having G20 leaders commit to swiftly implementing a new system of information exchange on tax, and to committing themselves to implementing the OECD's action plan to reform the tax system. This is all good stuff. But of course, it does require those countries to go back to capital level and actually deliver. And you don't get that at G20 summit. It just doesn't happen there. And finally, the deal and the agreements that they did make in St. Petersburg at G20 level gave absolutely precious little detail on how and when developing countries get to benefit from any new tax agreements that are made. And it also doesn't invite them into the room to help to develop and to negotiate what a new tax system would look like that would benefit them. And that's something we think costs nothing and was a big error on the G20's part, not to make a more explicit invitation to developing countries to have an equal place at the OECD table, like they did with non-OECD G20 members.
Dimitri Babich, you're joining us from Moscow. I wanted to ask you whether it was significant that this issue was brought to the top of the G20 agenda while Russia had the presidency. Is tax avoidance a big issue in Russia?
Indeed, it is a big issue in Russia, and I would say that Russia's position on tax avoidance is rather controversial. On the one hand, big Russian companies are now very active internationally, and Russia is interested in companies like Gazprom or Rosneft not meeting so much, discrimination as they do right now on the European markets. On the other hand, Russia is certainly interested in pursuing the corrupt officials and certain corrupt businessmen who find safe haven, sometimes in Britain, sometimes in other countries of the European Union. So on the one hand, there was this speech from Alexander Shokhin, the head of the Russian Union of Industrialists and Entrepreneurs, where he urged the so-called pro-growth regulation, with advocating the states to avoid corporate tax hikes and personal income tax hikes. On the other hand, Russia was very active in the so-called anti-corruption working group, and there was some interesting discussion on offshores. Well, I can tell you from my personal experience that when Ukers bought the newspaper where I worked, the Moscow News, we were stunned to find out that actually we were financially operated by an offshore company from Cyprus. So even on the grassroots level, on the ground level, sometimes in Russia, people suffer from the fact that certain companies cannot be really held accountable for certain bad things that they do, because they just don't keep their money in Russia. They keep it somewhere else, and they pursue the so-called tax optimization schemes, which is in fact tax avoidance after all.
You're listening to The Voice of Russia in London. I'm Vivienne Nunes, and today we're discussing tax avoidance. Looking at the general question of tax avoidance, I want to bring in Tim Worstel. Tim, you've got an interesting take on this. You say the multinational corporations we hear about are complying with tax laws that governments devised, knowing the consequences. So really, are the corporations to blame?
Well, yes, I always argue that there's no such thing as tax avoidance. There is obeying the tax law, which is tax compliance, and there is not obeying the tax law, which is tax evasion and gets you put in jail. There really isn't any grey area in between those two things. We even have a system which works out and decides which side of that barrier your particular activity is, and that's called the courts. And so I don't see that there is anything called tax avoidance in the first place. I would then also go rather further than that and point out that it's not actually a company or a corporation that bears the economic burden of corporation tax. It's either the investors in that company that do, or it's the workers in the economy where that tax is applied. Now, this has been known for well over a century. It's called tax incidence, and it's nothing unusual. It's not strange. It's not neoliberal. It's not even neoclassical. It's just a fact about the world that we inhabit, that companies do not carry the tax burden that's imposed upon them. It gets sloughed off onto other groups of people. The only reason we ever did actually try and tax corporations is because they're an easy place to get the money from. It's convenient to tax a company. But now with multinational companies and people being able to move things around the world, it's inconvenient to try and tax the companies, which is what leads to all these arguments about what Starbucks did or did not do. I mean, it's interesting to note that in the UK they didn't actually make a profit, so they shouldn't have been paying a profit tax anyway. But if it's now become inconvenient to tax corporations, then perhaps we ought to be recognizing the economic reality that the corporations don't actually carry the burden of the bill, and just stop trying to impose taxes on the corporations. Tax the shareholders, tax the dividends, just like income tax gains on shares with a capital gains tax, which is at the same rate as an income tax. Just tax it at the money at a different point in the chain, and this whole problem of corporate taxation entirely goes away.
Tim has a point, if I may jump in, but I wouldn't wish to accept without comment statements such as Starbucks didn't make a profit in the UK, because there is an issue of accounting transparency and accounting honesty. It's not just where do you collect the tax and at what point in the chain, is how much accurate and truthful information do you actually have about where profits are made.
Vince Cable looked into this, and Vince Cable came back and said, you know what? Our accountants at the business ministry looked into this, and Starbucks are quite right. They didn't actually make a profit.
Can you explain that to me, Tim? I mean, to me it sounds as though what they're saying is the costs of operating their shops in the UK are greater than the money they're making selling coffee. Is that what they're saying?
Yes, they made a lot. It's actually beautifully described in a book by Tim Harford called Undercover Economist, where he explains Ricardo's rules on rent. Basically, when you've got something like coffee shops that depend on passing foot traffic, then everybody will bid up the prices of those shops, which are where there is lots of foot traffic. And the profits being made in the business of selling coffee end up not with the coffee shop, but with the landlords. And that's exactly what happened to Starbucks. They took on too many leases at too many high prices. They didn't make enough money to cover that cost. They lost money.
So have they now cut down their leases? Do they now have less?
That's one of the problems you've got in the UK, in that you can't actually negotiate your rental downwards. Most lease contracts are upward revaluations only.
Well, you can close the shop.
Well, you can close the shop. Now, whether Starbucks is doing that or not, I don't know.
Can I come in and say it actually... Starbucks illustrates something else, because I think what it did do, all its British loss-making coffee shops actually paid rather large royalties for the use of the Starbucks name, and I think they may have even bought their coffee. People have different views as to whether it's very good coffee or not. Bought their coffee and made the profit on that coffee abroad in a low-tax jurisdiction. And that brings one to the bigger point.
Again, that's absolutely true.
But may I just follow through the point and broaden it?
For example, went through their accounts. FT Alphaville went through their accounts and added those sums back in, the royalties for the name to the Dutch company, the 20% commission on the price of coffee to the Swiss company, and they added them all back in, and still Starbucks UK was not making a profit.
Well, clearly Starbucks aren't a very well-run company if they can't make a profit in what is currently Europe's fastest-growing large country. But look, I was trying to broaden the point that when capital exists of a factory where you make a car or make something or have a shop which sells something, then you can actually identify where the business takes place. When capital is intellectual property, a set of ideas developed somewhere in the world, then it's much harder to work out quite where that activity takes place. I mean, the intellectual property, which is the thing that really drives a company like Apple, doesn't make its money so much on making things, it's the ideas behind it, are developed, mostly in California, but only mostly, because a lot of the research of these companies is spread around the world. So I think it's much harder in a world where your companies are not only multinational, but their profits are based on the cleverness of their ideas rather than their production, to identify precisely where that profit is really taking place.
I would agree, and it's sort of tied in with the point I made earlier that it used to be convenient to tax at the point of the corporation's profits. It's much less so now in this globalized world, and therefore, given that the companies don't actually bear the burden of the tax, give up on this idea, which is now inconvenient, and just stop having corporation tax altogether.
Why not tax them in line with their turnover in each country? As I say, there are precedents for that. Would you support that?
Yes, there was the unitary taxation in California.
Exactly. I've referred to it earlier. I didn't use the term unitary taxation, but that's what it was.
Indeed. I mean, certainly it's a possible way of doing it, but my argument is rather that because in an economic sense, this idea of tax incidence, in an economic sense, a company isn't actually paying the tax. It's either the shareholders or the workers in lower wages in the economies where that tax is applied. So if we used to tax corporations because it was convenient to do so, it is now inconvenient to do so. Let's recognize the economic reality that we're not actually taxing the company anyway.
Well, I wouldn't accept that it's inconvenient. I wouldn't accept that it's inconvenient. You can change the law and it'll become ultra-convenient again.
The fact that we're all having this discussion is showing that it is inconvenient in some manner.
But you're saying there, Tim, that the companies themselves can't actually be taxed because they'll just pass on the burden of that tax to customers with higher prices and their own shareholders. But if the burden of tax is going on to their shareholders and they see a lower return from their shares and profits, isn't that mean that it is getting passed on and the company itself, even if it is divided between a whole number of shareholders, is actually being taxed?
No, I'm afraid it isn't true. The two people that really end up carrying the economic burden are the shareholders, because they get fewer dividends because of the profits of the company. Some of it goes in tax and then the rest in dividends, so they get less of that. But also, if you tax the returns to capital in any one tax jurisdiction, then fewer foreigners will invest their capital in that tax jurisdiction. Now, average wages in any country are tied very closely to average productivity in that same country, and how you do increase the productivity of labor, you add more capital to it. So you start taxing returns from capital. This means that there's less capital invested in that economy. Average wages will be lower. It's not that the company says we're being taxed, so therefore we will pay you, the workers, less. It is simply an inevitable byproduct of trying to tax returns to capital, that wages will be lower in that economy, and therefore workers carry some of the burden.
Peter, you mentioned there'd been a system already implemented in California. Did they see less companies coming to invest there?
I don't think you can say that they did, but to be honest, I haven't looked at the long-term consequences of that. One of the reasons it was so difficult in the United States is a reason that doesn't apply as between national states, because in the United States we were talking about arguments between the constituent states of the USA. You see, California was, as it were, accused of trying to grab more than its share of tax revenue, some of which should have gone to other states who are all, it's as if Yorkshire were pinching tax revenue from Devon, which could happen, but that's not actually the central issue we're talking about here. I don't think there is a danger of the atmosphere in the G20 being poisoned by accusations on the part of, the Dutch that the British are pinching tax revenue from them. That's not how we tend to think in national states, even within the EU.
You're listening to The Voice of Russia in London, and today we're taking a look at what was achieved at the G20 summit when it comes to tax avoidance. I'm Vivienne Nunes, and I'm joined by Peter Oppenheimer from Oxford University, Hamish McRae from The Independent, Tim Worstel from the Adam Smith Institute, Emma Seary from Oxfam, and The Voice of Russia's Dmitry Babich. Coming back to the G20 then, what about individuals who avoid paying tax? We heard the leaders at the summit agreed to a new system of sharing financial information about individuals who stored their money in foreign bank accounts. Is this something we should be happy about?
I'm a bit gloomy about that. I think actually that the move was not taking place particularly to the G20 level, but it's been taking place at a bilateral level, with the Americans in particular going after their citizens who happen to have foreign bank accounts. And we've reached the stage where large Swiss banks have to disclose not necessarily the names of all the account holders, but have to disclose all the American the bank accounts that and then they can then track them down in practice, even if you're not actually handing over the name. Here in Britain, we've done deals with Jersey and Guernsey and the Isle of Man, whereby you either hand over the names or you discount or you knock off 20% or something like that of the interest that's being paid to people and give that to the UK government. The UK government's just done a deal with Switzerland whereby we're getting checks from the Swiss for collecting money from British people there. So I think that the mood against tax havens, used in their most extreme form, is already moving, is already gradually gathering pace.
Can I just quickly enlarge on that in the case of Switzerland? Very important, and I think it applies elsewhere as well. There is a definite incentive under these agreements between Britain and, say, Switzerland, for the individual Brits with account holders in Switzerland to declare them. Why? Because if they choose not to declare them, they will pay much more tax. The Swiss have promised the Brits that they will deduct 40% tax, where if you get an individual actually to say, yes, I've got an account here, they'll only pay 20%. There will be a price to pay for anonymity, continuing anonymity, which I would have thought many people think, well, this is ridiculous.
But there is also another thing happening, which is that people who want to not pay so much tax are finding other ways of getting round the tax thing. For example, they are forming companies. And we're going back a little bit to the situation of the 50s and 60s, where if you wanted to make money, you formed a company. You didn't have a job. And you could build up money in the company. And of course, governments want to encourage formation of new companies. So therefore, there are now very large tax incentives for Britons to become a company, not to be a person.
Yes, there's been some exposure there of public figures like Anne Robinson on television not paying the tax she ought to be paying for income earned in this country because she does it through a company. When I say she ought to be paying, well, that's for debate.
It's perfectly legal and actually encouraged by the government.
Only up to a point in the case of public employees. It isn't really encouraged, but I think we're getting a bit parochial.
Tim Worster, would you agree it is governments encouraging individuals to avoid paying tax?
Oh, well, I mean, obviously, I mean, we have a very, very good example in front of us. The old Soviet taxation system was quite alarmingly difficult and high, and then in the 90s it was changed to be a low and flat rated tax system. I believe it is still 13%, isn't it, as income tax in Russia? And what actually happened was that collections of revenue went way up because people stopped fiddling or moving things around or changing structures in order to pay less tax. If the tax rate's 13%, might as well just send a check. Why bother with trying to incorporate or offshore or anything else?
Peter, do we think that could work in Britain?
Well, not as low as that, no, because the normal level of tax honesty in Britain, for all the amount of avoidance that we have, is actually pretty high. Yes, there are people who make arrangements very rich. You get others who work in London but manage to reside in Monte Carlo or make sure all their income is in their wife's name and she resides in Monte Carlo. But your average Brit has a high standard of tax morality. And my word to politicians would be to say, look, yes, you've got to go after those people you think don't pay what tax they should, but don't risk undermining the compliance morale of your average citizen in cases where that morale is really quite and those principles are really quite good.
Just finally, I might bring Emma Seary back in then. Emma, what's your take on the agreements at the G20 in terms of individual tax avoidance?
Well, we did some research trying to look at exactly how much is held by individuals, and I think they can also be individuals who are registered as companies, so they're not global multinationals, but they could well be individuals registered as a company, a tax haven. And there's about at least $18.5 trillion being held in these tax havens because of secrecy arrangements that allow rich companies and rich individuals to stash their wealth offshore. Now, we're a development organisation, and we look at what kind of the lost opportunity is of having that money sitting idle in tax havens. And if you look at the tax loss the amount that you're losing in possible tax because this money's sitting in tax havens, it's enough money to end world poverty 4 times over. And at the G8, we pushed very hard for the UK government to do a deal with the UK-linked tax havens, so with the overseas territories and crown dependencies, to get them to commit to share more information multilaterally, so to join an agreement whereby they offer to share information not just on a bilateral basis, but with any signatories of an existing convention, which just gives more power to developing countries who are signed up to that agreement, that they automatically receive information. Now, at the G20, there was an agreement for a new global standard of automatically sharing information globally, tax information. What they agreed was a deadline for G20 countries to start doing that. What they failed to do was to commit when they think it's feasible and how they think it's feasible for developing countries to receive that information. So whilst we think that the G20 did put their head above the parapet on tax this year, more words than action, to be very frank, but it does put the first nail in the coffin of tax dodging. However, we don't think big global companies or the super rich are going to be having too much trouble sleeping just yet.
Would you agree it's been more words than action, or are governments finally getting something done on this? Hamish McRae?
I think there's a move towards getting companies to pay some tax, and I think there's a move to getting rich individuals to pay some tax. And there will be better coordination between countries in the future, and I think that's good for society. But the harsh truth is that, as I said earlier, if a country can see an advantage by cutting its tax and offering a tax incentive, it will do so, and it will find investment goes towards it. So there is always a practical issue here, which is that a tax incentive is also, for some, a tax loophole.
Peter Oppenheimer?
I'd just add that, look, this isn't a once-over matter. Are we making progress tackling the problem? It isn't the problem. There's a constant jockeying position, a constant inventiveness on one side and the other to change the law or to get round the law in your own interest and so on. This is a continuing problem in any economy, and that means all economies, where the provision of services and indeed goods is shared between the public sector and the private sector, and the public sector has somehow to achieve transfers of money through taxation and in other ways from the market routes of the system to its own coffers.
Tim Worstel, final comment from you.
I feel that the G20 and, in fact, the whole basic debate about corporate taxation is simply going the wrong way. There definitely seems to be a feeling that people think that what a company actually offers to the economy that hosts it is how much tax it pays, which, of course, is ridiculous. I mean, the value of Starbucks is that we can buy bad coffee from them. The value of Google is that we can use the Google search engine. How much tax these people pay while they serve up these things to us is almost an irrelevance. We ought to be concentrating on what is actually the value of a company, which is the goods and services that they provide to us as consumers.
That's all we have time for today. I'd like to thank each of my guests for joining me here at the Voice of Russia in London. In the studio, we heard from Peter Oppenheimer from Oxford University, Hamish McRae from The Independent, Tim Worstel from the Adam Smith Institute, Emma Seary from Oxfam, and the Voice of Russia's Dmitry Babich. A big thanks to all of you for taking part. Next up on Voice of Russia is the news. Welcome to the Voice of Russia in London. I'm Vivienne Nunes. Today we're looking at the G20. No, not the diplomatic wrangling over the crisis in Syria, though that certainly dominated the summit in St. Petersburg last week. Instead, we're talking about what the leaders of the 20 biggest economies achieved on the issue of tax avoidance. Here in Britain, we've heard a lot about multinational corporations with million-dollar profits not paying quite as much tax as perhaps we'd like them to. Starbucks, Amazon and Google are all dodging the bullet when it comes to coughing up, or so we're told. The G20 leaders now say this practice must be addressed, and they've signed up to an action plan aimed at taxing companies where their economic activity takes place. Today, we're going to discuss what has actually been achieved and what still needs to be done. Joining me here in the studio is Peter Oppenheimer, an economist from Oxford University, and Hamish McRae, financial commentator and associate editor of The Independent. On the phone is Tim Worstel, senior fellow at the Adam Smith Institute, which supports a free market economy, Emma Seary, head of development finance from Oxfam, and on the line from Moscow is Dmitry Babich, the voice of Russia's political commentator. Thanks everyone for your time. To begin with, I want to look at the issue of tax avoidance itself. Over the past few months, it's been front-page news here in Britain. We're told Starbucks paid no corporate tax in Britain last year, despite making $600 million in sales, while in the US, Apple avoided paying billions in tax through a complex web of subsidiaries. But here's the crux. We're told corporations...
global turnover which was made in that state. There's no intrinsic reason, actually, why countries shouldn't do that individually now. But as I say, I suspect they're sort of politically frightened.
Hamish McRae, you were watching the G20. We've just heard Peter Oppenheimer say it wasn't the forum to address tax avoidance. What's your understanding of what was achieved?
Well, I think that it focused attention, and that's a start. And it focused attention, this is picking up Peter's point, back on countries themselves, because one country's tax loophole is another country's tax incentive. And you can't really blame companies for putting their stuff in Ireland because it has a 12.5% corporate tax rate and employing quite a few people there when rather than pay 30-something% in the United States. And I think, therefore, that cooperation between countries to agree what is a sensible tax.
Operating within the law, albeit immorally. Peter Oppenheimer, is the media painting a fair picture of what's happening when it comes to tax avoidance?
Well, broadly speaking, I'm delighted to tell the media, yes, I think they are. There is a problem here. What's not clear to me is whether it is necessary or indeed of any value at all to have the G20 talking about this collectively when actually quite a lot could be done by countries acting individually. The difficulty is that countries are then scared that any benefit they get from increased tax revenue as a result of their individual action may be neutralized by them acquiring a business unfriendly image which discourages investment. If I may make a historical point, I think years ago, and I'm not up to date on this, the state of California in the United States had a law requiring companies to be taxed in that state according to the proportion of their global
tax regime. So you don't have these quirks that you can employ whereby you put all your intellectual property in one place, a little tiny country, Luxembourg or wherever, and don't pay any tax on it there, and then you make your profits there, and because it has a special deal for foreign companies, rather than actually try and spread the tax take evenly, roughly where the business is done.
So you've said it's focused attention, so now the issue has been brought to the fore. But have any regulations been put in place or any recommendations been made so these 20 countries are given some impetus to put in place new tax arrangements?
You don't get that from the G20. That isn't what it's doing. The G20 is a new body, remember, only 5-6 years old, formed to give a wider collection of countries when the economic crash hit. And it did very well then in an emergency.